Hey everybody, Courtney Smith here with our Wall Street winners for May 31st. All right, let's dive right into it. Oh my God, this is so incredible. All right. So I think the situation's a little bit more bullish. I'm still not wildly bullish. I still think we're in this kind of grinding bull market. And so there's some pluses and some minuses. This chart shows a plus. Look at the purple predictor just skyrocketed in the last week. And so I had been counting it as bearish. I gotta say it looks much more bullish now. So that's very positive for the market because it means that the smart money is buying the S&P. Now, the Dow Jones, not so much. But nonetheless, there's still buying pressure in the market. That's the little green line above the red line in the upper right-hand corner. So the green line shows buying pressure, and it shows that buying pressure is increasing, even though selling pressure is decreasing. Now let's take a look at the black line. The black line is a measurement of trendiness. It's the ADX, and it measures trendiness. And when it's going down, it means that the market is in a neutral market. And I think that's pretty obvious from looking at the chart. But notice it's starting to flatten out. And if it were to turn up, that would be a good indication that we're in a solid bull market again. So we're going to watch this closely now that we're flattening out. The NASDAQ, very weird price action. So pretty strong price action, but the purple predictor is dribbling lower. It means they're selling it. They're selling the NASDAQ as it gets up here. So I think our premise that we've had for months now, which is we need to be in interest rate and economically sensitive stocks rather than NASDAQ, high-tech, growth type stocks. So got to stay focused on these stocks that are sensitive to interest rates, are sensitive to the economy, not stocks that are insensitive to those things. Okay, so now that we're at the end of May, let me explain something. So basically what we do is we say that the end of April is the end of the normal seasonal period, but we allow ourselves to hang on for an additional month and consider it still bullish as long as we don't break my sell line, which is the red line on the chart. Well, now we're at the end of May, and now I kind of stick it back to neutral. Now, you can see the price is still going up. We still haven't broken the red line. But from now on, we won't be putting on big positions. We'll be putting on average size positions. So if you normally buy 100 shares during the seasonally bullish period, you should be buying 150 or 200 shares. But now I'm going to go back to 100 shares. Now, the next time I'm going to start looking at seasonality is going to be the beginning of September. Okay, because the seasonal period starts October 1st, but sometimes it starts a little early. So we'll start looking to switch this to bullish starting September 1st. But Utes are currently during the bullish period and have yet to break the red line that I've now put on the chart. I didn't have a red line here for a while, but now we're creating, I think, some strong support there where I have the red line. But clearly, Utes are not behaving bullishly. Even though we're in a seasonally bullish period, they're not going up. So we're not getting very aggressive in the Ute sector. Now, here's something a little disturbing. What we want to do is we want to look at the focus on the red line, and then there's a light purple line and a green line. So the purple and the red are the ones most in power this year. But the green line is all post-election years. The point is all of them declined this week, okay? So actually over 2 weeks, and particularly the red line does. But nonetheless, those three lines are the lines to look at. So I said there was mixed bag. I like the purple predictor getting more bullish on the S&P and the buying pressure coming back in on the Dow. But unfortunately, the seasonality is negative for the next 2 weeks. So we may fail to make a high. We're very close to new all-time highs on some of these indexes, but they may fail or they may poke their head above the old high and then drop down again. So we can't get real aggressive right now. And then the asset allocation says that, well, there's no new money coming into the market from the bond market. The bond market's on strike. It's saying you've had enough money. We've been giving you money for a year. We're through with that. We don't want to give you any more money. So bonds are now no longer supportive of the market. Our RISKDICATOR got a nice bounce this week, but you'll notice that it's lower than it's been for the last several months, saying that the market doesn't want to take a lot of risk here. Now, let me go back to the previous chart. So what this is saying is bond investors are saying, you know what? We like bonds better than stocks. We're fine right where we are. We don't want to add any more money to a risky thing like stocks. We want a conservative thing like bonds. Our RISKDICATOR is saying the same thing. Only here they're saying, you know what? We want stocks that are not very risky, i.e. high-flying tech stocks. You got it? We want kind of boring stocks, maybe staples. We kind of want things like food in our portfolio. So when there's a lack of risk, stock markets don't bound up. Stock markets rely on people wanting to take additional risk. And you can see it. The whole chart was, let's get more risk, let's get more risk. And now we've flattened that out for 2 months, 3 months actually, since the beginning of March. We haven't gained any on the risk front. A same story that we saw in asset allocation. Now, global shares are actually outperforming the U.S. So I got to get more interested over here. I've kind of been poo-pooing it because the U.S. has been stronger than global shares for so long. But I think next week we'll start to dip a toe into the international stock market. Yield curve also flattening out. This is related to the bonds not going anywhere either. They're not putting money back in the bond market because they can get the best yield they've gotten in like almost 2 years by putting their money in bonds. And so they're saying, good enough. We'll take the little yields we get on bonds and we'll leave the stock market to those youngsters. All right. So here's the bond market, very flat. I'm still bearish. I'll show you why. But notice the purple predictor started to go lower this week. This thing's going to crack eventually. All of our indicators are saying that interest rates have to go up. So, well, if all the indicators are bullish, guess what? I'm sorry, bullish on yields, bearish on bonds, okay? I got to be paying very close attention. So we don't have a technical signal to get short yet. So I don't have an order in yet, but I'm bearish on bonds, and I think we're going to see higher interest rates. The dollar is heading lower against really mainly the euro. It's actually moving higher against the yen, but against our main trading partners, so that would be Canada and Mexico, we're seeing the dollar decline, and it's a clear bear market. So if the dollar is going down, that means gold is going up. Oh, my butt is sore from being kicked so often because I'm not long gold. Okay? So I've been talking bullishly for a long time, but then I've been backing it off. That's bad trading, folks. That's a bad move. I'm supposed to catch a move this big. And you know very well, I've crushed it in the gold market here over years and years. So I'm a little embarrassed right now. Okay, anyway, it doesn't matter. We'll make it up, and we'll get long gold somewhere along the line. Okay, our gold key indicators, though, this is one of the reasons we've basically been having neutral indicators over the last several weeks. So I've kind of said, okay, I'll wait for us to get a nice dip in the gold market, and then I'll step in and buy. But, well, as you can see, the indicators are pretty neutral right now, maybe even a little bearish, but let's call it neutral. So we can't buy gold unless our indicators are bullish. Crude oil moving a little higher, and I am ever so slightly bullish on any industrial commodity. So copper, crude oil, tin, lead, zinc, all of them, because they're sensitive to the business credit cycle. So just like we talked about, we're more bullish on the S&P and the Dow than we are on the NASDAQ. Same thing. We have to be bullish on raw materials. Bitcoin, on the other hand, we don't need to be bullish on this because it's backed by air. There's nothing backing it up. So if I want to if I want to have something that's backed by air, I'll go to US dollars because everybody takes them, but hardly anybody takes Bitcoin. Here's the thing. We got the collapse, and we told you about that. That worked out pretty well. We've had the rally. Now we're going to go make another collapse. And if we broke that low down there at about 30,371, I'd get short. Now, I really trade Bitcoin using futures contracts or CFDs. Now, CFDs are not available for Americans, but for non-Americans, you can use CFDs. So you only have to come up with a couple $100. So you can play something that's worth $30,000 for a couple $100. That's a pretty good deal. All right, freebies, love having you here. We'll keep you straight, we'll keep you in the straight and narrow on this stock market. But of course, the best thing you could do is to actually subscribe. It's a peanut for all the value you get. There's a ton more indicators we go into and specific trades, and those specific trades pay for your subscription. Don't forget, good newsletters don't cost money. They pay you money. All right, fully paid up members, hang on for just a second.